everyone. Guillaume Letron here, host of the E-Commerce Wizards podcast, where we feature leaders in business and e-commerce. Today's guest is Evan Padgett, who's the COO of Stealth Venture Lab. We'll be talking about subscription business, especially for e-commerce, but in general. We'll talk also about raising money, angel investors, VC, venture capitalists, and building a whole subscription brand. Before we get started, we have a sponsorship message. This episode is brought to you by MageMontreal. If a business wants a powerful e-commerce online store that will increase their sales, or to move piled up dormant inventory to free up cash reserves, or to automate business processes to gain efficiency and reduce human processing errors, our company, MageMontreal, can do that. We've been helping e-commerce stores for over a decade. Here's a catch. We're specialized and only work with the Adobe Magento e-commerce platform. We do everything Magento. If you know someone who needs design, development, maintenance, training, support, we got their back. Email our team, support@magemontreal.com, or go to magemontreal.com. That's MAGE Montreal.com. All right, Evan, thank you for being here today.
Thank you for having me. Happy to be here.
Yeah, can you give us some of your background here? Because you have an impressive background in subscription brands.
Yeah, so I've been in subscription commerce for about 20 years now. Really cut my teeth at a company that was called Intermix Media, selling all sorts of weird subscriptions online. And I would say weird, it was early 2000s, 2002. All sorts of weird subscriptions, beauty products, skincare, toys, and anything, you name it. This was a company that ended up getting bought by Fox Interactive Media for MySpace. We were a sister company within the same company as MySpace back in the time. That same group of people that were building the product marketing division, consumer packaged goods, we jumped, ended up at another company that ended up being called Intelligent Beauty, focusing again on skincare and health and wellness products. I was a junior marketer there, focused on, this would have been like 2006, focused on Google, SEM, and basically conversion rate optimization, even before it had that name, before it was called conversion rate optimization. That company then evolved into some of the biggest fashion brands out there, known as JustFab and Fabletics, Savage X by Rihanna. And I sort of grew in that company for about 10 years, started as a marketer, ended up jumping into building out our data and analytics and business intelligence department, which serviced all the brands that we were incubating. Ended up growing into customer service operations and grew our customer service operation from, at the time, about 130 people to about 600 people, while managing analytics and sort of creating systems for all of that. Took over our acquisition marketing efforts as an executive lead, overseeing how we were spending our money. We were spending about, at the time, about $100 to $120 million a year globally on advertising. Then from there, jumped right into basically running one of the companies, JustFab, as the brand president, general manager. And then we acquired ShoeDazzle. So I ran both those companies for a period of time, managing a pretty significant P&L and a big team. Awesome job, awesome company. I owe a lot to them from what I've learned, because I spent about more than a third of my life working there. After that, I left and went to a company called Thrive Market. Awesome online grocery company focused on delivering healthy foods and some of the best foods for you, gluten-free, organic, etc., dietary needed foods all across the country. It was a really awesome experience, joined up as their chief marketing officer during a major part of their hypergrowth. And then after that, met my business partner here. I was introduced to my business partner here at Stealth, Brent Freeman. And from there, we've been building this thing up ever since. And so I sort of jumped from in the client world to a client services world. And at Stealth, here we're just trying to make an awesome team, delivering awesome output to all of our clients, servicing clients primarily in subscription, but we have traditional e-commerce clients as well. But doing all their paid acquisition, creative, and just growth marketing for them, and working to grow them and having fun doing it.
Sounds good. So it's quite a run. So now, if I understand correctly, now you currently actually take on clients to do a paid acquisition for them, and then you'll help them build their brand, especially if it's a subscription business. And you also start your own venture of subscription business. Can you tell us a bit about that?
Yeah. So we have, we sort of quote unquote eat our own dog food a little bit here, and so we work and build businesses up ourselves internally. And frequently, a few times a year, we actually test and try to find viable businesses, looking at the market, looking at what could be really viable in paid acquisition, and we'll build up our own brands inspired by just sort of what the market's looking for. So not necessarily taking from the clients we work from, but actually just looking and saying like, oh, here's an opportunity, or is this a brand we should build into? And we've built, we run sort of a proprietary system to test the feasibility of a product to market. And we spend about a few times a year, we'll spend about 6 to 12 weeks developing a facade brand, testing it, reviewing how it's doing with real marketing dollars, and seeing if the economics make sense. Like, can we get the CAC where it needs to be? Is there a need for this product in the marketplace? And if that's the case, we go out and do it. One of our biggest successes is actually an in-house brand of ours called knownalive.com. In short, it's especially awesome during the pandemic, but we know personally this amazing family in Italy. And when the pandemic hit a couple years ago, they're in the they are in the hospitality business. They run a bed and breakfast. They do these cooking classes with real Italian grandmothers, Nonna Norina, and that all went away overnight, right? Travel stopped, everything. So we said, hey, let's partner with them. Let's build a platform for them to have. They were doing this with Airbnb a little bit too, but let's do virtual cooking classes and build that out. It's been an awesome business ever since then. Even now, still people taking several virtual cooking classes all the time. And we launched an olive oil brand directly from Italy, directly from this family's vineyard or olive garden, to be able to bring this to market. So we sell our own olive oil direct from Italy. And that just kind of came up because we saw an opportunity in the marketplace. We knew this family was going to need help and support because hospitality and travel just disappeared overnight in March 2020. So boom, we found a really cool business to build just sort of out of necessity, and everybody won with that one.
That's a surprising choice. Like, of course, with COVID, then you can feel the need. There's a void to fill right away. Okay, no more travel, no more family meetings, and so on.
Yep.
But it's still as a choice to say, okay, I'm going to go with like finding grandma who can cook and teach people. They say, hey, that might be a scalability problem to some degree. But it's like, okay, that's very interesting, because if you're able to actually unblock that, then you can have a platform like Preply that you have people who just put their own hourly rate and start teaching other languages. So interesting venture there.
Yeah, exactly. So we try to do that a few times a year, just with other ideas, just sort of spinning out sort of what the market can bear. It's a good opportunity. Like, we have a handful of criteria we run this against. So we call it our 5 criteria for finding product market fit, basically, which is always important. It's pretty easy. It seems pretty straightforward, but we score this. We actually created an internal scoring system for this, and the higher the score, what we see is the higher likelihood of this product being successful. Sort of starting with, and for people that are listening in, this is how I think everyone should evaluate their business opportunity, is on these 5 criteria. These aren't necessarily all inclusive, but they cover a lot. And it starts with having a passionate audience. There's a passionate audience in this case means you have a group of people, and the next point is also the size of the audience, the next bullet. You have a group of people that are very excited about what you are offering. Meaning, if you are a mountain biking company, and you sell mountain bike accessories and mountain bike products, or mountain bikes themselves, you have a very interested fan base, right? You have a group of people that love that. Same with skiing, same with beach, same with travel. You have a passionate interest that drives people together. So having a passionate audience, then coupled with having a large audience. I'll use the best example that comes to mind, and we work with a lot of the best meal at home companies out there at Stealth. Meal at home, everyone's got to eat, right? So your audience is pretty much everybody ages 25 to 45 or even older that would order your products online. So having a large audience and a passionate audience, when you have both of those, huge tailwinds in your favor. A unique value prop. This is the one that that most brands struggle with the most. And the reason why is if they're not first to market, they're looking at their competitors at all times. And I'm not saying that's a bad thing. Like, it's a good thing to understand what your competitors are doing, but everybody has a tendency to try to be like, I'm just going to do what they do, but do it a little bit better or do it a little bit cheaper.
That's a mousetrap, 10% better. It's not.
Exactly, right? Like your competitor has months or years of runway in front of you, plus, maybe they may have competitive advantages you don't understand. So unless you can own the supply chain for whatever you're trying to compete against, you're going to have a hard time with that. So having a unique value proposition says, especially if you're chasing the market, what can you do differently? What service can you provide that your competitors can't, that makes you unique? Having uniqueness is obviously important. Can there be me toos? Can there be number twos, number threes? Of course, without a doubt, right? But if you can have a unique value proposition brought to you by, say, owning part of the supply chain, if you're a coffee distributor, being able to own your supply chain from start to finish can then allow you to sell your product at remarkable prices, right? And that creates, and yet still generate more profit. That could be part of a unique value proposition, but you got to have something that says we're different than people you're comparing us to.
Yeah, especially when you start a Me Too product line. I mean, you're going to have all kind of other issues than just like you might not even think about up front. Like, how will you motivate your employee when you start growing your team and you have dozens of people working for you? It's like, oh, our objective is to be number 2 or number 3 in the market, and
right.
We don't have a vision and we're not different.
Exactly.
How will you motivate your troops with that?
So exactly. So you got to try to get to, when you're doing that, if you're going to create like a competitive Me Too type product, you get to the same baseline, but at some point you got to divert off. You got to say, we're going to go this way, and my competitor is going to go that way, or my competitor is going that way, so we're going to go this way, and we're going to place our bet someplace else. If you don't do that and you just try to keep chasing your main competitors, all you're going to get is dirty because they're going to leave you in the dust, right?
Yeah, you don't need an Elon Musk vision if we're going to go to Mars, but you still need a little something that's different.
Exactly, precisely. And like a good example, I'll use meal at home again. You have, when you look at almost every meal at home company, they try to attack a vertical within meal at home, right? You might have, hey, this is one that's great for paleo diets, right? Or high protein, low carb diets. This one's made to be an awesome meal at home cooking experience. So you get the ingredients and you cook it and you end up with a final plated product. You have ones that are vegetarian only, ones that are explicitly meat. So they all try to you have a bunch of meal at home companies, but then they all kind of get their own little corner of the space, because very few meal at home companies really just service all. They don't have vegetarian and gluten-free and high carb or high protein, low carb, and also just regular down home and Southern cooking, or Indian cuisine or China, whatever. They don't get super try to be all for everybody. They try to just kind of carve out a space, which is like what you have to do if you're thinking about being a number 2, or not trying to be a market leader, a market innovator, but trying to chase.
You have to, even from an operational point of view, how will you upkeep the supply chain of all those variety of food? And then when you talk with your potential client, who's, let's say, a vegetarian, and you only have 2 vegetarian meals, you're not a very interesting choice,
Precisely, right? So got to have some uniqueness to go along with it. The next one is really good unit economics. So when I say really good unit economics, I'm always thinking about it being able to have the ability to advertise. So I'm not talking about building an organic brand that over time gets PR and gets influencers, or has only has a celebrity backing it, so their PR ends up being them plugging the company, so you don't have to spend money on advertising it. If you want a brand that you can spend money to acquire customers on, and be able to attribute that fairly well, you need to have good unit economics. When we say good unit economics, in consumer packaged goods, I'm looking at 50% gross profit margins delivered to the customer, meaning cost of goods, shipping, freight, blended, everything. If you're selling something for $100, it doesn't cost you more than $50 to get it to that customer's doorstep, not including media, not necessarily including your team and SG&A when I think about subscriptions. Now, when you are talking traditional e-commerce and not subscription, you have to have a much better, ideally a much better profit margin there, or such a high AOV to cover your customer acquisition costs and make sure you get a ROAS of 3 or 4 or greater if you're in traditional e-commerce for that to make sense. But the reason why you need that is if you're just looking at your customer acquisition cost to LTV ratio, you want that to be at a comfortable level for you to be able to spend money in media, because that comes out of your revenue as well. So if you have 50% of your costs on that first order going to just the product cost and shipping on $100 order, that leaves you $50 of sort of below gross profit. Well, now you're talking about taking customer acquisition costs. Maybe that's 25 or 50 bucks, especially if it's a subscription. Now you're not leaving much below the line there. If your customer acquisition cost is, say, $45, you're left with $5 left. Now, subscriptions, which I know we're going to talk about a lot, that's the beauty of subscription. Guaranteed downstream revenue. So you're not trying to necessarily crush it on that first order, which is why subscription products do incredibly well in advertising. You can monetize that customer over a 3, 6, 12-month period. And when you do that, that allows you to pay more to acquire the customer. And there's a kind of a basic rule of direct-to-consumer acquisition marketing. The one who can pay more for the customer usually gets the customer, especially on a head-to-head race. Like, if you can outbuy them, doesn't mean you have to spend more. Like, don't take that as like a cop-out saying, oh, we just throw money against the wall and see what sticks. But in reality, if you could pay more because your LTV is higher on than your competitors,
lifetime value, yeah.
you can buy that customer more often than they can. And then the last piece on my 5 criteria is that it's got to solve a pain. This one's kind of simple, but it's got to make people's lives better. It's got to solve a pain that people deal with. Most relatable and keep it consistent, meal at home companies. What they do, not only do they deliver food to your doorstep, but they save you time from not having to go to the grocery store. They save you headspace by not having to think about what you have to cook, or if you need to go buy stuff. Like, they just solve that. They remove that anchor from you, which is a huge pain to many people. As somebody with 3 kids and a wife, sometimes it's just easy knowing, like, hey, we're going to make this tonight. Like, we got this deal. We got this meal that we're going to craft at home. It's ready to go. We just have to throw it all together and cook it. That's easy for us. That makes our lives better, and that solves a pain in our lives. So you have all 5 of those things: an audience that's passionate, an audience that's large, unique value proposition, compelling unit economics, and a product that solves a market pain. You got a really good shot at having a great product market fit product.
Pretty cool. Yeah. And from your previous point about the lifetime value, LTV, of the customer, I guess you just go for as many months of amortization of your cost of acquiring customer as your finances are able to bear. Is it 3 months, 6 or 12? Have you seen some kind of a standard in the industry, or is just what your finance can afford?
Yeah, so it's both, right? The more that you finance and can afford, in theory, that's great. But industry standard, you want to ensure, and also just kind of cash flow advice, you kind of want to ensure you're getting your media payback at least to the full bottom dollar by like month 3. Like, so in that example before, say it's $100 first time order, 50% margins. Then you get $100 on subsequent orders. You should be able to make sure that say your CAC was $50. You want to pay that $50 CAC back by about 3 months. There's several reasons for that. I mean, the biggest one being, your monthly advertising spend times your media payback period is essentially working capital tied up in media. So if you're spending $100,000 a month on media and you have a 3-month media payback, you need to have $300,000 working at all times just to keep your media platform afloat. And if you want to grow that, you got to invest into that, right? So you need margin to do that. So 3 months is excellent. 6 months, if you can afford it, great, but you're going to start running into cash flow issues, especially if you want to grow.
Because you need to multiply. So let's say you want to increase by 50,000 your monthly spending in your 100K example, then you need 150,000 extra because it's 50K over 3 months. So
Exactly.
and
then if that media payback period is 6 months instead of 3 months, now all of a sudden you need another $300,000 in working capital just to increase your media spend by 50 grand. So like the modeling and the financial planning and analysis is critical here, but an average subscription, you're typically looking at a media payback in 3 months. You're not. This is one thing that scares people, and I get it. I totally get it. It's very counter business, but like most subscriptions, I have seen only, and mind you, I've been a part of a few dozen, and then worked on hundreds at this point. I have only seen probably 5 that actually are subscriptions that make their money back in consumer packaged goods on that first order. And the only types of products that could do that are really just ones with exceptional margins. So healthcare, health and wellness products, skin creams, beauty creams, stuff like that. Those things, big surprise probably to no one is like fashion brands and fashion products have like typically 75 to 80% margins. So if you're doing that and you're getting a great customer acquisition cost, you can make money on that first order. Most subscriptions do not make money on that first order when you include customer acquisition cost. And that's uncomfortable, right? You're like, I'm sending my product at a loss. But that's where the beauty of subscription over time really starts printing money. It's kind of like a curve that goes below the line for a period, and then when you get enough subscribers, it just shoots right back up. And that is how that works out. But everyone gets a little concerned on that dip.
Of course. And talking about that dip in the financing ability, have you experienced either with raising money, seed capital, venture capital, or just you purely finance it yourself?
So my experience has always been, I've been a part of significant fundraising events, especially pre-stealth. When I was at what's now known as Textile Fashion Group, all those fashion brands, JustFab, Shoe Dazzle, Fabletics, I was there when we raised probably over a 10-year period, $400 million. Not even an exaggeration. This is information you can kind of go look up and see. And then when I landed at Thrive, they were in the middle of hypergrowth. While I was there, had nothing to do with me being there. I don't know, saying that because of that. But when I joined up, about 2 months after I joined up, they closed a $111 million round of fundraising. Different time. This would have been 2016, 2017. But fact of the matter is, those economics, especially because of what you can show in your financial planning and analysis, is really exciting to investors frequently. Because, not to go too deep down the fundraising route, but like when you're presenting a subscription business, you have a lot of power in an exciting subscription business and talking with people that would invest, because you can usually show a plan that says, hey, I don't need to take money because I'm going to build up. Now you're posturing a little bit, but you're like, I'm going to build up subscribers. I'm going to reinvest my own capital. We're going to be able to keep growing, and we're going to grow slower, but it's still going to be, we'll be profitable and cash flow positive in 8 months and profitable and, on a return on all of our dollars in 12 to 16. And it's just not as exciting, right? And we leave ourselves open. But hey, if I get capital, if I can raise 10, 15, 20, $50 million, whatever size you need, then it's like, okay, we can now own our supply chain better, or we can create a new competitive advantage, or we can get into another vertical and do that more quickly. Plus, hey, I can ramp up advertising more quickly now because you guys see the data. You guys see how we're doing it. I know I could double media spend. I just don't have the capital to do it right now. You can paint a really exciting mathematical story to investors, and this is something I've spent a lot of my career doing, is basically showing how the model works. And it's absolutely rooted in reality. These are not just, anyone could put something on an Excel spreadsheet and make it say whatever, but the reality is there. So when you're not distressed, you can raise money on good multiples, because you can kind of be like, well, I'd like your money because, I could grow faster, I could grow quicker, I could secure myself as a number one or number two, even in this vertical, which, when you're number one, you can't stop people from giving you money. But when you're number two, everyone's like, hmm. But if you're a market leader and you can show this graph that says take it or leave it, gives you a lot of clout. And I'll go back to, this is a story that Nick Green, the CEO at Thrive Market, tells from time to time, and I'll never forget it, which was before I even started working there. He told the story of when they were growing, they kept reaching out to venture firms to try to raise money, and they kept basically crushing their goals month over month over month. And he tells the story literally going back to the same investment groups every single month saying, yeah, so we crushed that goal and now our valuation's higher. And they're like, we're not sure about this. And they're like, okay, see you in a month. They come back literally a month later and say, all right, you know that goal? We absolutely crushed that goal too. So instead of seeking 10 at a $50 million business, we're now seeking 20 at 75. And then now we're seeking 25 at 100. And it just kept growing and growing and growing until they, like, after like the fifth or sixth time, they're finally like, okay, fine, like we're gonna invest now. And that's like how they got their primary initial Series A, I believe, was based on the persistence and based on being able to not just show how the growth was working, crush each of those numbers at every interval, and then basically keep raising the stakes higher and higher. Say, like, we're gonna keep coming back because we want money to grow, but every time we come back, you could have gotten in at a much better deal if you had just invested the first time. So that's the fun part about subscription models. Really good FP&A, really good. I enjoy the numbers aspect of it, and there's a lot to play with there.
What kind of multiple have you seen in terms of valuation in the fundraising?
So part of that also depends on what stage you're in. A lot of subscription businesses seeking like a Series A or a Series B even are not bottom line focused right now, or historically have not been bottom line focused, meaning they're not necessarily running at huge EBITDA numbers. You could show how they could, right? You could say, hey, we could be conservative, but we know we could go out there and raise money. So depending on where you're at, you can really, it's all about trying to game what your evaluation could be. And that is highly subjective. And certainly right now, I would say capital markets are a challenge for all, without a doubt. When capital markets are loose and you're able to get funding, you're talking about setting your evaluation, at somewhere between 3 to 5 up to 3 to 5 in a loose market, 3 to 5x your forward-looking revenue. Not even a problem. Like next year's revenue, you could create a model saying, hey, we're at 20 million this year. I think we're going to do 40 million next year, and then get like a 3x multiple on 40 million when you're doing like 20 this year. Like that was not impossible. Right now, probably a little tight, because here's the rub. The rub with subscription products and the rub with CPG in general is, what's the exit strategy? Like, a lot of money has been pumped into consumer packaged goods. You look at some of the ones that have transcended into public markets, the Chewies of the world, Stitch Fixes, some of these other ones, they certainly have their ups and downs. They ride the wave of what the capital market's doing. So it's, it's hard to keep besting yourself, but to raise money at a good evaluation and to hope that, like, if you have an exit strategy in mind saying like, hey, I'm building this fashion brand that I hope to sell one day to Target or something like that, and they're strategic investor or have strategic interest, then maybe that can happen, right? But I would say right now, compared to 6-7 years ago, your multiple's a little less. You're probably talking about 2x your forward-looking revenue, maybe.
And if you think your forward revenue will be twice this year, it's like 4x of current revenue.
Which is still, that's a big maybe right now, because you're gonna like, if you're out, if you have somebody out there trying to fundraise right now, they're probably getting a lot of like, hey, yeah, come back in a few months. Like we're gonna see how things are shaking out right now. It also just kind of depends on if you're a distressed business or not, and that's obviously when you're distressed, meaning in this case having to raise under duress. That's a very different ballgame. You're probably seeking debt capital instead of a traditional Series A, because not a lot of those are closing right now.
Yeah, of course, there's uncertainty with the war in Ukraine right now, tightens a little bit the market. You see the Feds and Bank of Canada and so on increasing base points for interest rates. Of course, it's a slight tightening of the money market, but it's still very reasonable, I think, right now, because we're in those wave patterns. So it's likely they'll forecast or that they will still raise by a few more points in the upcoming months. So there will be a little bit more tightening to rein in the inflation.
Right.
So it's still better to do it now than to wait, because it will be harder in 6 months. If you need capital, it will be harder in 6 months. There will be even more tightening of money policy.
If you got a strong business and you can represent strength right now, then my advice for a lot of our clients, we have many small clients too. Clients that are spending $30,000, $50,000 a month on advertising, so relatively small compared to ones spending millions per month. Is just being focused on your bottom line a little bit right now, a little bit more so in the face of uncertainty. It's likely to get worse, sort of categorically speaking, before it gets better. And also, just there's a lot less money being distributed right now because you have a situation where the private equity firms and the investors are waiting to see how brands shake out right now. And that's kind of the unfortunate nature when things get challenging like this, socioeconomically speaking. You end up running into, well, let's see if you could survive 4 or 5 months, then get back to me. Let's talk about that then, because if you have the cash, you're like, well, I like that business, but maybe I'm going to risk it and say, I'm going to let them sweat a few months and get more equity at a better valuation, right? That's your job as an investor. Better for me evaluation, better for the investor evaluation, meaning take a few $1 million off the top and get a bigger percent for the same dollars. So yeah, but right now with subscription companies, again, if you could present a vision of strength and opportunity, raising money is still really possible. They're still deploying money into good businesses. And if you have a good business, you can go out and get money.
Yeah, because there's never been as much money as there is now. Because of COVID, they've printed money like crazy.
Absolutely.
Which is part of the inflation problem. So, like what you're saying is true, that there will be more, demanding. They will filter harder on who to invest in.
Yeah.
But there is an unbelievable amount of money available for investment.
Floating around.
You have like Warren Buffett complaining a few months ago, hey, there's a lack of good investments right now. They want to pour capital in businesses.
Yeah.
So but unless the war is over in a few months, that's the only way I could see things really improving in the next few months of this year, because you will still have hikes in interest rates regardless to just rein in inflation, because it's going over 10% in some places in the world right now.
Absolutely. And the supply chain is a major issue. Like if you're in consumer packaged goods, like SaaS companies right now, if they have businesses to support, awesome place to be, right? But if you're in consumer packaged goods, you have extra wait times of your product on the water. And going back to marketing, right? The same thing with subscription and just in general consumer packaged goods. Guess what? You have to order your product and pay for it more months in advance because it's taking longer to land here, for example, in the United States. Well, that's working capital that you have to pay for product that's going to be sitting on a boat or sitting on a shelf longer than you'd like it to be. And that capital's got to come from somewhere. And that is the tug of war that happens with subscription. Whereas you mentioned earlier, if you're increasing your media budget, getting more customers means buying more inventory later to support those customers. A subscription, you have to project out like, oh, I have 5,000 subscribers right now, but at this rate in 10 months from now, I'm going to have 15,000 subscribers, hypothetically. Now I need to buy product in 10 months from now that supports 15,000 people. So now my costs have gone up there too. So not only has your media gone up and working capital there, you're now having to pay more for inventory that's going to take longer to get here. And no vendors are offering small guys terms that says, oh yeah, pay part to ship and pay part when it's landed. Like everyone's collecting in full before your product ends up on a boat or on a plane. So that's kind of tough right now. And so again, I'm not saying that to dissuade people, but it's a consideration for your working capital. If you're getting in to consumer packaged goods and you have a supply chain that exists outside of the country that you're in, you're going to need more capital to support it because you're going to have to order earlier. Then you're going to have to tie up that capital longer, and you got to make sure that you can afford that. And that's going to be, if you can't buy your product, you can't do your advertising. It's a recipe for setting your business down the drain or putting it in a really distressed position where you're like, oh my gosh, I got vendors that won't ship my product, so I'm calling up every investor that I can and saying, I need $2 million right now. Otherwise, we're not going to be able to buy this. And I mean, nothing an investor loves more than hearing about, oh, you're in trouble? Okay, what's your okay, how about this multiple? And I'll write you a check tomorrow. It's like,
not even 1x multiple, 0.5 multiple.
Yeah, exactly, right? They're like, yeah, how about your company's almost out of business? Okay. No, but like, again, it's a necessary part of this, but that is the strategy, right? So you got to be, the more you're ahead of the game, the more you're saying, hey, I need capital in 8 months from now to keep up this growth. I don't need it right now, and I can run a more conservative plan. You can posture really great to investors. Yeah, but if you're calling them saying, my product's not going to ship unless I wire these guys $10 million or $5 million in a few weeks, well, you'll get that money. You're going to give up a lot more of the company than you'd like to get it, though.
Yeah, exactly. So basically, without the venture capitalist backing you, you focus more on profits. Yeah. And only when you have the VC, then you play the crazy game of, okay, let's run a deficit to grow faster. But then there's always the problem here that you may run out of VC capital a little too fast, which is what we hear everywhere.
Yep.
And then you need to raise again, and you're dependent on that thing going on.
Precisely.
So, yeah, it's quite a game. But let's say you were talking about your other example, raising $100 million there. That was probably not a round A. Was that like a C or a D round, or?
That 111 at Thrive, I believe, was a B.
A B, okay, that's a big.
Again, this is 2016. It was a pretty loose market back then, and I think we had raised about $30 million beforehand. And then that business had been around at the time for, I want to say since 2014, so it had been 3 years old, but was sort of for a period of time really the hottest company in LA as far as popularity and consumer packaged goods subscription. So had a lot of clout behind it. And grocery is a tight margin business, right? So doing subscription grocery required a lot of capital to build out because we were at the time, starting to develop our own brand. They now have, I think, over 1,000 or a couple thousand SKUs that are Thrive Market only SKUs. They have to build out their fulfillment center. They have a supply chain of millions and millions of products and tens of thousands of SKUs. So it's cost intensive, and anybody who's ever been in grocery knows that margins when you're a grocery retailer, like a grocery store itself, doesn't necessarily make a lot of money on every product it sells. It just sells a lot of product. Very different model. So yeah, that was like I'm pretty sure a Series B, and then at Textile, the collective, 400 million was probably through D. That was over a 10-year period of raising money.
Okay, so we've talked about your 5 criteria to decide, is that a good venture to start? So let's say somebody comes up with something matching all 5 criteria. Now, let's walk them through the game plan. What's the high-level strategy here for a startup? So you say, okay, I'm going to start this business. I put a bit of my own money into it. I'm going to look for venture capitalist backing or seed money or angel investors. Like, what's the step-by-step play of building a new subscription business?
Yeah, so step-by-step as I see it, depending on what you have to start with. Let's just say you're able to get, I think any business coming to market these days, you're going to have a little bit of that angel money. So friends and family, angel funds, you need capital to get something off the ground. Now, if you have some skill in the sense of something tangible that you could do, like if you could build websites or you're an expert in supply chain logistics or something like that, obviously that makes a huge difference in some of your costs, but you have an idea. And let's just for the sake of this, say you're going with a subscription product because I can speak most familiar to that. Launching a subscription product, I always advise getting a read on what the market's going to think about your product. So we create facade brands. You could create not necessarily a facade brand if you wanted to, but you could do a pre-release of your product. Try to generate a little bit of buzz. See how it's received. Spend some advertising dollars against your pre-release. And this is like not too different than how people have been doing it with like Kickstarter and stuff like that. Like there are marketing firms that help you market your product through Kickstarter if you're an innovative product, which is how a lot of brands really came to market or have come to market historically, or crowdsourcing, not just Kickstarter, just crowdsourcing broadly. But all that's doing is taking place of angel money, kind of, and creating a little bit of marketing buzz around your product to begin with. So you need some capital. Call it several $100,000, most likely to be safe. Call it maybe $500,000 would be a great cushion if you got friends and family that you can get that from. Get your web presence going. Getting a good, solid web presence on an e-commerce platform out there, Magento, Shopify, any of those, is not actually super cost intensive to get an initial product out the door. You can work with, freelance designers. A lot of these platforms have a great WYSIWYG, what you see is what you get style interface, so you could drop assets into a template and build a competent website yourself. Like, there's no reason that a young, or it doesn't even matter, an entrepreneur of any age couldn't build a competent website. Not the best, but one that conveys the message, has a good UI UX, and converts. Like,
yeah, you'll need a SaaS system. You need like a Shopify for that. Magento, you'll need coding knowledge, even just install an extension. But yes, and anyway, if you're a startup, unless you have good backing, if you got $500,000 of backing on fund, okay, you could go Magento. But otherwise, you should go more with the SaaS or something like that to start on a simpler level. Basically, when you start a website as a startup, you want to keep the cost low on the platform itself, and not be too demanding on design tweaks and all that, and just like keep it simple, template modifications and so on, and just spend a lot on advertising and marketing and products, and not that much on the website's mechanic aspect for the startup phase. Then you'll probably need to re-platform when you grow a bit more, but still
exactly right. So
approach.
Yeah, the re-platforming piece, or depending on how unique your subscription is, like the kinds of subscriptions I've been a part of when we were building at Textile, this was pre any of those out of the box platforms anyway. We built totally custom, soup to nuts. That entire e-commerce platform is still entirely custom. When we were at Thrive, we were on Magento, and that was because we had our own warehouse management system that plugged in. It was just very custom with a unique subscription model. So depending on, as you evaluate a subscription that is, hey, here's a monthly, quarterly, semi-annually, or annually subscription and a fee, and you get products in a box, you can use a turnkey solution. If you have things that are complex and layered, like some of the examples I think of are, extreme flexibility in the subscription model, or subscription models that lead to access into specific product types or verticals. So let's say you are a silver, gold, or platinum level subscriber. You see different products or have a different level of service, basically a highly custom solution. Then you would want to invest in the technology more at the beginning.
That's it. And just there, a little bit of clarification. Like, I have full episodes of podcasts like Magento versus Shopify and stuff like that, if you want all the details. But like in a one sentence, it's like the more simple the project, the more Shopify it is. The more complex the project, the more Magento it is. So it's like multi-warehouse, multi-language, multi-country, multi-whatever. Then you're typically looking more to Magento. And if you're in the startup phase with good venture capital or just good finances there, you would want to keep it as simple as possible, almost out of the box as is. Just launch, spend your money on marketing, spend it on acquiring clients, on the product market fit stuff, and then you can say, okay, at least I have a Magento that they can customize later when there's more revenue, more investments.
Absolutely.
But you have like, okay, you can say, I'm going to keep the Magento simple for phase one, and I have the possibility of customization later on down the road that I would not have, let's say, with a Shopify. Shopify would still be good to scale up to a few million. So I've seen migration both ways, from Shopify to Magento, Magento to Shopify. But for most startups, typically something like a SaaS software would be like a Shopify would typically be a best pick for a startup. And a Magento is more for the more established companies.
Yeah. That makes absolutely. You're absolutely right there. And I think that's the best way to think about it. And keeping it simple out of the gate is definitely preferred. And if you have capital and if it needs to be more complex, if it needs to, some of these businesses kind of need to be like, I will admit that, like, again, I'll come back to this example. It's just easiest for me. Meal at home companies tend not to be able to do that well with Shopify out the gate, because you have highly custom menus. You can send out 50,000 boxes that have 50,000 different configurations and things like that, because of what people can order and what products they can't eat, allergies, all this stuff. That sort of stuff starts getting too complex for an out of the box Shopify build, where you would want to build your own or work with a Magento type platform to be able to launch, custom code, because, like, you can end up with, as you said, multiple fulfillment centers, multiple suppliers. If you're having to get your green onions from this, and you have to order 500 green onions and 300 of chicken breasts from this supplier, that sort of stuff, and you want systems that do that automatically, that doesn't happen out of the gate with a Shopify.
I can relate. We've done exactly that. Migrate a food subscription business that was running on Shopify. We've migrated them to Magento, butcherbox.ca, and our clients there.
Oh, ButcherBox, okay. I'm very familiar with them. The client of ours.
The Canadian one, the .ca, not .com, not the US one.
So back to what I was saying. So you're starting a business, you have an idea, you have a concept, keeping it simple, you have capital, you go to market and start advertising. Now, where do you advertise right now? You advertise everywhere. I used to, 2 years ago, before iOS privacy really took hold, before iOS 14.5 really grabbed and changed things. I would say, hey, don't even bother with anything except for Google and Facebook, Instagram, until you're spending $150,000 a month. Then you start looking at more channels. Now, you try to create an organic presence everywhere and try to market everywhere, and make sure that you have, if you're going live to market, you want to make sure you have a good $25,000 to $50,000 in advertising to understand how the market's going to respond to you, because no matter what, us included, your first go to market will not work. I have, probably I can count out of the hundreds of I've been a part of over time, only a few have ever just like turned their product on and been like, oh, customer acquisition cost is looking great and this is scalable. Like, just does not happen. So then you have to listen to what the market's telling you. You have to say, okay, how am I stacking up with pricing? What do I need to do? What do I need to change? Is my offering good? Listen to the few customers you do get, and actually try to get information from the customers you don't, the people that sign up maybe and don't end up converting, or they come to your site 3 or 4 times and you trigger them with a pop-up saying like, hey, why aren't you buying? People fill that stuff out, right? Like, they really do. And they'll say, I don't like anything you're selling, or it's too expensive. It happens a lot. Or it's just not what I'm looking for. But listen and modify and make sure make sure you're open to, every entrepreneur needs to go in knowing that the first version of their business will not be the one that gets them to where they need to be. Show me any business that has grown to even $10 or $20 million a year in revenue. It is different than when it launched. It is going to be different. The pricing model, the subscription model, the merchandising, whatever. They've had to expand in certain areas, contract in others. It's different. So you're not going to figure it out before you go to market. And when you realize that, you put your best foot forward based on what you know and be ready to adjust and change. This is one of the hardest things that I've seen entrepreneurs struggle with, is adaptability there. Because you don't want to change it. You want to make your product work because you believe it so much that it's the right product. But if the market's selling you, it's you're off. And it's going to show you that by customer acquisition costs doesn't get where it needs to be. Your LTV is lower than it should be. You're going to go nuts trying to make that product work, when in reality, small steps to the side, adjusting your pricing, maybe going from a monthly to a quarterly subscription, maybe just reframing how you look at that 5 criteria and say, oh, I'm not explaining how we solve a pain for this customer. I'm not explaining that, like, oh, by getting our product, you're now saving 100 hours a year waiting in line at the grocery store. Like, it's easy to miss that mark because you see what your product can do. And as an entrepreneur, you know in your head what your product can do, but you have a tiny ad and a landing page, if you're lucky, to explain that. And you need to find a way to communicate that. So have flexibility when you launch. Be curious on testing and read the data. Like, the data tells you everything that you need to know. And if you're not sure about some of the data, find ways to get more of it. Like, find ways to do screen recording technologies all over the place. Hotjar, one of my favorite apps ever. Like, I love that. I get to see what people are doing on the screen. I get to look at their journey, and I can only look at so many. But you start noticing, like, oh, no one's even paying attention to this thing, which is all that I see when I look at the page. You have a biased set of eyes when you're in the business. So be ready to adapt and grow, iterate. And the last thing I'll mention, above all, and this is my bias as an analyst and as a data person in general, have data that backs everything that you do, including a financial plan that backs what you're doing. Because managing your cash flow, managing your incoming revenue in the future from subscription revenue, understanding and tracking your churn and the most important KPIs for your business. When you are a subscription business, there are more KPIs to track. Like when you're an e-commerce business, you're pretty much just looking at ROAS and revenue in, and you kind of like, you hit the mark, you miss the mark, your return rates, things like that. But with subscriptions, you're watching on e-commerce, plus you're looking at, churn. You're monitoring an LTV number. You're bouncing that LTV number against your customer acquisition cost at all times. You're having to look at your cash flow because it's a different cash flow model than when you're on regular e-commerce because you tend to grow more consistently with subscription versus e-commerce, where you have like some e-commerce companies make all their money in Q4, make 70% of their money in Q4 for the holidays or something like that. And then, the other 25% throughout the other 9 months. So they plan for that.
Golf. Just go play golf. You close it and go play golf.
Right, exactly. Pretty much. So you have to, if you don't have a pro forma financial model that is continuously updated, monthly at least, looking at your churn and main KPIs, you will get caught off guard at some month being like, well, why is my money like this? Or why am we like, I hired some people. Why is our revenue not growing? And you're going to realize like, oh, remember that month we spent a lot on media? We got a lot of crummy customers because we were leveraging affiliates too much, and we got a bad cohort. So our LTV is actually 30% lower, which means our payback period's now longer. It means we have more working capital tied up. And oh my goodness, like this is a worse picture than I thought. So if you do anything well, you got to be obsessed with your numbers and not just manage your business off a bank account, which I've seen businesses do. Be like, oh, my bank account's growing every month, so we're doing something right. It's like, oh my gosh, track this stuff. It's all there.
Yeah, if you're going to track from the bank account, at least use the profit first method from
Right.
Mike Michalowicz. At least,
but
split it into a few accounts, and then you just like split profits, taxes, and operation expenses.
Exactly.
At least. Okay, so that could be good. So let's say we have the big picture. There you have your 5 questions. Let's say you have a great idea that matches all 5. You create your base website, the base Magento Shopify site there. Magento if you want to customize more later. Shopify if it's more of a simpler business. Okay, then you go you raise some money from friends, investors, angels around it. Maybe the first $500,000, mix of your own pocket and others. And then you would try to go see venture capitalists to inject, like, how big do they start typically? Like $1 million, a few millions, and when should you go and see them in terms of like business volume? Do you wait to reach like your first $1 million a year, or do you go before that, or when do you go?
So this is my take on this. Part of this is a personal decision, right? It kind of depends on how confident you think you can go further and how much of the company you're willing to give up, right? Because if you go for a friends and family round, convertible note, or as part of that being a debt that you're paying back with interest, depending on how they sit on your cap table, you have to be ready to give up more of your company. Now, you have, my mindset is if you're ever basically seeing yourself running out of money within 6 months, you need to be out raising. If there's a world where you can run out of money in 6 months from now, and that feels like a long time, but with supply chain and media changing and everything like that, it's not very long. If you have a plan that says, hey, we're going to be way too low on cash in 6 months from now, you need to go raise. Now, how much you raise? Well, that really, if you say you're through your first $500,000, even $250,000, somewhere in there, your friends and family round, good friends and family, wealthy friends and family at $500,000. Everyone else
has that.
not everybody can get that, but if you got people that are waiting to invest in you, That's
Yeah,
interesting.
you probably need angel investors for most people to reach 500,000, unless
Yeah.
you have, like you said, wealthy friends and family. Like
Yeah.
it's probably
You've been
more.
part of companies
Yeah,
where someone's already done it before and they're like, yeah, I'll invest into you, right? That can happen. Leverage your network. You never know, right? You never know who knows whom. So usually after your sort of initial round, I would say on average, I see people raising at like a $3 to $5 million round. And that would be after they probably get, north of, if you can take $500,000 and get it to, about a $3 to $5 million a year business, then you start looking at raising, $3 to $5 million and giving away a big part of the company at that point. Like you can still say, hey, we're a $5 million business. I think we're going to be able to double or triple because those first couple of years you get those doubles and triples and even quadruples go from 5 to 15. It's not crazy if you have capital. So maybe you give away 15 to 20% of the company, to get a couple $1,000,000. But that couple $1,000,000, that's got to last you, in my opinion, until you're getting a pretty serious named round, a Series A. At that point, you're probably going from friends and family to angel to Series A. That Series A, that is your. I always like to say, try to treat that as the last bit of money you ever have to raise. Doesn't mean it's the last money you'll ever raise, but your Series A, shoot for like 20 million, $50 million, depending on your size of business. But now you have to be big. You can't just do 20 million off of a $20 million a year business. But that previous few $1,000,000, you get that kicking out $30 million a year, something like that, and say, hey, I need growth capital because I'm in a business that I want to buy my warehouse. Or you never want to buy a warehouse. Don't ever say that. But maybe I want to re-platform and develop out my tech. I want to jump into 3 new product lines because these are complementary product lines, and I got 1,000,000 subscribers here. I know I can get 100,000 subscribers if I offer this too, just from my 1,000,000 that I have. All these things, right? Come up with a business plan, raise a Series A, and at that point, hope that you never have to raise again. And at that point, you're looking at or if you're raising, you're looking at, in my opinion, strategic investors, meaning somebody that makes your business better and or somebody that will potentially acquire you after your Series A. So you're like, hey, these guys have interest. If you're a meal at home company, take some money from another meal at home company that may want to acquire you someday, or a private equity firm that has connections into the meal at home company. So then they all kind of talk and they all figure that out, right? So after your Series A, you are only ideally looking for strategic investors to then produce an exit for you someday. If that's how I would run it. Now, a lot of subjectivity. Brands can raise through Series A, B, C, D, E, et cetera, and stay private and go longer. But
yeah, but
to
when you
each
reach
their
a
own.
Series E, I mean, you probably have like nothing left of the company, 2% or
Right,
something.
right,
You know,
and then
the founders
also
of Netscape, like
right,
multi-billion-dollar
exactly.
company have no money.
I would also just, I guess the last piece on this is actually just have a little bit of a destination in mind. Meaning, look, if you're trying to build a company that's wanting to be a publicly traded company someday, very different path than somebody that's trying to say, I want to build a company up and sell it for $50 million or $100 million someday. Like, awesome wins on both sides, but a different mindset absolutely required if you're like, I'm going to have a public company. I'm going to ring that bell in New York City. Nothing wrong with that, but your fundraising path does usually go into the B's and C's, does usually go with a round that's $100 million or more, does go with, as a CEO there, you go from, hey, I'm building this business in my garage to your job is then managing your board and investors and keeping them all happy as a private company to then take it public someday. Very different paths. So like I'm speaking more from, you're an entrepreneur and a home run to you is creating generational wealth for your family and your family's family and stuff like that. Stop at a Series A. If you're going to create a public company, guess what? Everything gets more expensive. You have to have so many controls in place. And I've been a part of companies that have gone public or gone down that route of going publics. And you have things like, SOX compliance, Sarbanes-Oxley, man. That is a heck of a process to go through just to become compliant with your financial controls, your communications, and all that. Not a bad thing. It's just a lot of work and takes a lot of time. It takes a lot of money to do that. So if you get to that point, good problems to have. Congratulations. But
Yeah.
also, Your fundraising doesn't stop there, and you gotta be big picture thinking. At that point, if you're not innovating, if you're not the market leader trying to make a publicly traded company, you're never going to get there.
No, but basically the IPO is the $1 billion play, and the other one you're saying is like, hey, that's $100 million play, and I'm done.
$100 million play looks good to most.
Yeah, yes, exactly. We don't all need to build the next Tesla or whatever.
Right. I mean, then you got the $1 trillion play, which you're in for 20 years if you're doing that. So, but hey, congrats to those.
Yeah, well, maybe you should not aim for that.
Don't start there. Do probably not start there unless you're like Elon Musk or something.
You probably have higher odds of winning the lottery if you run the math, but I'm
absolutely.
Not sure. Yeah,
like winning the lottery like 3 times, probably.
Probably. Something like that. Because you have like, what, $6 trillion companies right now?
Yeah, exactly. Out of all the hundreds of millions that have existed and failed. Yeah.
And from the stats I've seen, it was like less than 7% of businesses are just over $1 million a year worldwide. Right. And then it was like 0.4% were over $10 million a year. And then you have in that 0.4% everybody from else. The 10 million to the $1 trillion caps, so
yeah. I we were talking, I want to close out with one big mind shift thing here is there's absolutely no shame and also it's a great business to have. I've worked with several businesses that basically create a cozy little cash flow business for themselves. Businesses kicking out $10 million a year in revenue, operating off of 10 to 15% EBITDA margins. So they're putting a couple $1 million down and back into the company. And they have a light cap table. So being an owner, you're able to take distributions and tap into that money and leverage that asset. Like, that's an awesome living too. Like, not every, there's depending on what your goal is. And like, some people just want to build a business to see where it goes. And there's so many different motivations. But like, I've worked with a lot of those people that just have, like, for lack of better words, almost a family business. They have it with they have a staff of 20 or 30 people. They're growing comfortably, but not overextending. They're profitable pretty much after their first year. They take in some growth capital here and there, but they don't give away much of the company. And an outcome for them is they get cozy enough to where they're either kicking off a bunch of cash for themselves, great, or they get swallowed up for, rounding errors by bigger private equity companies that are, or bigger conglomerates that'll be like, hey, we want to own every company in this, niche fashion subscription box space. And they just go around and swoop them all up. Like, that does happen. Like, the sweeps of smaller to mid-sized subscription box of $10 million a year type boxes, they get rolled up every so often. Every few years, that I should say, that happens, and probably soon to happen again, because then you get groups that'll be like, oh yeah, we're just going to own every niche little fashion box or niche little outdoor subscription box or something like that, right? And then they just buy all those up. So then that could be an exit for you too. And if you have stable economics, they'll hit you up and be like, hey, what does this look like? You're like, yeah, I own like 92% of the company. Here's what our economics are. I've run a profitable company for the past 5 years. And you can go on a lower multiple and just make a deal happen and get a huge win because your cap table isn't infused with people that think that a 3x return is a miss, So that's another way to go about it. And that is a great way to run business. And like you said, those are those businesses that sit in like, even if they're $1 million business, if you're kicking off 25% EBITDA margins on $1 million business, plus you're paying yourself along the way, cool. Like $250,000 a year that you could tap into. You keep building that for a little while. Run this for 5 years. You got $1 million just in cash, just sitting there. Sell it, maybe $5 million, or you just shut the business down. Boom, you got $1 million. So, or just run the business efficiently.
You sell it because then
you're absolutely
wasting the asset.
Yeah. But I'm just saying, like, that you're in a winning position regardless in that case. So, interesting stuff, man. Interesting stuff. This is a great talk.
Yeah, it's enjoyable. Any last, shotgun question, any last thoughts or suggestions, let's say, to someone starting out a new subscription business on that path there?
I would say embrace a certain amount of patience and embrace a certain amount of flexibility in what you're trying to do. And patience, flexibility, and curiosity. And what that manifests itself is be curious about how your business is running and how your metrics and KPIs look. So do not lose sight of that. So curiosity and KPIs, having patience about how the market receives your product, and then just in general being able to persevere through turbulence in marketing conditions and just make quick and try to make quick decisions instead of overthinking it. It's the market will tell you again how your product is. Like they will if you're trying to advertise it. It's not about what you think. You could try to convince them, but if you're trying too hard to convince them, you're missing something. So just take a good look inside, and you'll be better off for it.
Perfect. And if somebody wants to get in touch with you, Evan, what's the best way?
You can find me on LinkedIn, just Evan Padgett. You'll see my profile pop up. There's not too many Evan Padgetts out there. Evan at stealthventurelabs.com. Reach out over email or just post on our website, stealthventurelabs.com. There's a contact us, and that's another way to reach me as well if the previous two don't work. I always love talking about the industry. Just reach out anytime. Always happy to give opinions and thoughts about anything, and a lot of that I candidly just really enjoy contributing to this industry, and if you want to talk about it, let me know.
All right. Well, thank you for being here today, Evan.
Thank you for having me. I appreciate it.